This split screen represents two colliding realities in modern wealth management. On the left, donor-advised fund assets have climbed past $234 billion as clients shift their expectations toward holistic charitable planning. On the right is the single folder icon, the manageable start of a DAF practice. Overseeing one account is a straightforward courtesy, but as a practice grows, that single folder multiplies. A typical firm now manages between 30 and 50 of these accounts simultaneously, each belonging to a different client or family. Most firms market themselves as providers of sophisticated philanthropic planning. However, executing that promise requires an infrastructure that can handle dozens of distinct charitable entities without losing efficiency. What begins as a strategy to secure assets under management can slowly shift into a high-maintenance administrative task, competing with an advisor's core planning hours. To service just one client's DAF, an advisor must navigate to a specific sponsor portal, clear two-factor authentication, verify cash balances, and vet the intended charity before a grant can be processed. The friction compounds when these clients are spread across different platforms like Fidelity Charitable, Schwab Charitable, and various community foundations, each with a unique interface and separate credentials. Because these portals are highly secure, they employ aggressive session timeouts. During the year-end giving rush, staff often spend as much time requesting new 2FA codes and relogging into portals as they do actually advising on grants. This manual approach creates a logistical weight. It turns a premium, high-value service into an unscalable administrative burden that limits the firm's ability to grow. This diagram maps an advisor's path across 3 different sponsoring organizations. Each branch terminates at a unique login screen, and each portal is gated by its own separate two-factor authentication requirements. To keep workflows from fragmenting, firms are moving towards browser isolation as a technical countermeasure. Adopting tools like Sendwin provides sandboxed, simultaneous logins. An advisor keeps multiple sponsor portals active in one view, eliminating the constant logging in and out cycle. When these simultaneous sessions are integrated with planning software like Orion or eMoney, the advisor gains a centralized view of charitable assets alongside the rest of the client's portfolio. Managing multiple DAFs at scale requires moving away from ad hoc manual effort and committing to a centralized technology stack. With the portals organized, the focus shifts to the assets themselves. It is often tempting to leave newly contributed DAF funds in default money market pools to avoid the extra work of reallocating. These pie charts show the cost of that convenience. A client looking to grant funds over a 3 to 5 year horizon needs the growth profile on the right, a custom allocation of equities and alternatives, rather than the stagnant cash pool on the left. Offering tailored allocations maximizes the donor's long-term impact through tax-free compound growth. To do this accurately, the DAF data must be integrated into portfolio management software like Black Diamond to track performance. Leaving DAF capital uninvested misses the primary financial advantage of the vehicle and ignores the growth potential for the client's chosen causes. This timeline illustrates a bunching strategy. By concentrating several years of a client's charitable giving into a single tax year, the contribution rises above the standard deduction threshold, maximizing the immediate tax benefit. Advisors time these contributions to coincide with high-income years, such as a business sale or a significant stock vesting, to offset large capital gains. This strategy requires deep coordination. It necessitates working closely with the client's CPA and running complex scenarios inside modeling tools like MoneyGuide Pro to find the optimal contribution amount. While the upfront planning is significant, these quantifiable tax savings often serve as the bridge to involving the client's children in the giving process. By turning the DAF into a multi-generational legacy vehicle, the advisor secures a role that extends beyond the original donor to the heirs. This framework segments DAF management into distinct service tiers. Solo advisors under 150 million AUM should stay in the basic tier, using browser isolation to stop repetitive logins. Managers with larger books must build the comprehensive stack, integrating CRM to execute complex tax punching. Attempting to offer a family office level of customization using a basic technology stack is the most common way a practice breaks its operational capacity. There is a stark financial reality to consider. DAF management is typically bundled within an advisor's overall AUM fee. It is rarely billed as a separate revenue stream. Because of this fee structure, every unbillable minute spent troubleshooting logins or manually entering grant data is a direct loss of profit for the firm. Systematizing multi-account management with a unified tech stack isn't just client service. It's the only way to protect the practice's profit margin while scaling.